In today's video, we're going to talk about a few new rules that you may not know about that will allow you to increase the amount you are contributing to retirement accounts. Some of these rules are available to you right now. Some of them will be rolling out in the next couple years. Let's talk about how you can save more into your tax advantage accounts. Now, before diving into these rules, I wanted to give you an update on how retirement contribution amounts have changed from 2024 rolling into 2025. Contribution limits are set to adjust to inflation. So these are targets that you will see steadily rise on a continual basis. It's important to note some contribution targets have a rounding feature of sorts to the nearest $1,000 or $500 mark. This is why you may see certain years with no change to something like the 401k catch-up contribution. Say we saw 2.5% inflation. Well, logic would assume that we see a $7,500 401k catch-up rise $187. However, it seems that on certain limits, the IRS seems to want to keep cleaner numbers. They may not make an adjustment in this year because it is not yet enough to round up to that nearest $500 mark. So now that big picture, we have the contribution limits on the screen. Let's jump into some new and important rules that you as a retirement saver need to know. Rule number one, starting next year, a subset of retirement savers will be eligible for an increase in their 401k or 403b catch-up contribution. A catch-up contribution is an additional amount the IRS allows you to contribute to a specific account if you are over a certain age. Normally, the catch-up contribution applies to those over age 50 for 401k and 403b, and that is $7,500. In past years, this catch-up contribution did not differ depending on your age. Just as long as you were over the age of 50, you were eligible for that contribution. However, in 2025, a new Supercharge catch-up contribution has become available for those ages 60 to 63. As with the normal catch-up rule, your age at the end of the year is the age you would use for eligibility. So if you turn 60 by the end of next year, you are eligible for this increase. The increased catch-up for 2025 grows by an additional $3,750 for a total of an $11,250 catch-up. Again, this only applies if you are age 60 to 63 by the end of the year. Once 64, your catch-up reverts back to the previous catch-up level. Rule number two. This is a rule we've known about since 2022, but 2024 is the first year you can actually use this contribution rule, and this rule allows you to take excess funds from a 529 plan and roll it over into a Roth IRA. 529 plans are a college saving tool that can be extremely valuable, but as you are saving for college for a child over 18 years, some families will find themselves in a situation where they oversaved. This is problematic in a 529 plan because any withdrawals from this plan that don't qualify as college-related expenses will have a 10% penalty. The ability to take $529 and instead divert them into a Roth IRA is a great solution for families that oversave. But here are some key rules that you need to be aware of first. Rule number one, the rollover must happen to the same beneficiary of the 529 plan. So if it's your daughter's 529 plan, the rollover can only happen to your daughter's Roth IRA. The annual limit of rollovers is constrained by the Roth or traditional IRA contribution limits and rules. This means the max you can roll over for someone under 50 is $7,000. Just like if you were contributing to a Roth, you need to have earned income to make that contribution. Also, anything you contribute directly to your Roth or traditional IRA will offset this rollover amount. So say you want to use the 529 to Roth rollover strategy and your daughter has $5,000 of earned income this year and has already contributed $1,000 to their Roth IRA. The maximum you could roll over in this situation is $4,000 because $5,000 would be their actual limit due to the earned income constraint, and then they've already contributed $1,000, which lowers their eligibility to $4,000. Additionally, the 529 plan must be at least 15 years old. The lifetime maximum rollover amount is $35,000. But the big benefit here is there's no modified adjusted gross income limit for contributions. If you have a child fresh out of college earning a great wage that would prevent them from otherwise contributing to a Roth IRA directly due to those income limits, they are still eligible for this 529 to Roth rollover, which is a great added benefit to get at least some dollars into Roth accounts early in their working career. Rule number three, simple and SEP IRAs are less common, but a new rule for 2023 and beyond allows these account owners to now make Roth contributions where this was previously not allowed. Typically, the only people who will have a simple or SEP IRA plan will be either owners of small businesses or employees of small businesses. Simple IRAs have some unique benefits because they are very cost effective and quite simple to set up. SEP plans are typically used when contributions are generally coming from the employer, and these plans can allow for pretty sizable contributions. Again, in the past, the only option was for contributions to these plans to be pre-tax contributions. And then when you eventually pulled the money from these plans, you would then pay the tax at that point, just like a traditional 401k would work. Well, as of last year and going forward, Roth contributions are now allowed, giving the employee a little bit more freedom for their tax situation. Make sure you are aware of this rule if you have either a simple or SEP plan. Rule number 4 is one that's not a new rule by any means, but is one I wanted to include in here because it's one of the most common ways I see families miss out on easy and powerful contributions. We are talking about HSAs or health savings accounts with this rule. HSAs offer retirement savers a tax advantage like no other account can. When you contribute to an HSA, you get a tax deduction on the amount that you contribute. That money can then grow without any taxes owed during the growth period. Then, if you withdraw from an HSA to pay qualified healthcare expenses, you are able to withdraw that money completely tax-free. So if used properly, the money going into an HSA will never be taxed, making this the most powerful retirement account. Now, note here that you are only eligible for that catch-up contribution if you are over the age of 55. This is different than the age 50 401k rule. Now, here's where people get confused. If you look at HSA rules, you will see the maximum individual contribution at $4,300 and the maximum family contribution at $8,550. Due to these maximum contribution rules, so many workers assume that they can only do the family maximum plus one catch-up contribution for a total of $9,550. And this is the case if you and your spouse share an HSA. However, if you and your spouse each own a separate HSA, you can actually get another $1,000 contribution. For instance, one person can contribute the family maximum to one HSA, which is that $9,550, which also includes that $1,000 catch-up. The other spouse can then contribute their $1,000 catch-up to a completely separate HSA to gain a total benefit of $10,550 between the two accounts. So again, this is not a new rule, but one you should definitely be aware of if you're contributing to HSAs. Finally, rule number 5 is going to be a big change for a good portion of viewers of this channel. This was a rule that was originally set to be enforced this year, but due to issues with how the rule was laid out, it is being delayed until 2026. Come 2026, if you are a worker with wages over $145,000, any catch-up contribution to your 401k, 403b, or 457 plan will be forced to be Roth contributions. Previously, workers had the choice whether to go pre-tax or Roth with their catch-up. Generally speaking, the more you earn, the more you would actually preference your contributions to be pre-tax. For instance, if you're in the 32% tax bracket, there's a good chance you want to receive a deduction today on your contributions and basically save on that 32% tax. The bet here is that long-term you would be able to withdraw from your 401k at rates cheaper than 32% and effectively make out better than contributing to Roth. Come 2026, however, you will no longer have that option with those catch-up contributions. However, there are quite a few rules that you need to know about with this rule. First, this again only applies to company plans like 401ks, 403bs, or 457 plans. This will not apply to IRA contributions, and the Roth IRA income limit will still exist. Second, it is based on the previous year's wages for that specific company and plan. So say in 2025 you made $140,000, but in 2026 you are set to make $150,000. This rule would not yet apply to you until 2027. Here's another situation where it would not apply. Say you are working with company ABC in 2025 making $200,000, but switch to working for company XYZ in 2026. This rule will not apply to you as you did not make $145,000 plus for company XYZ, which is now the plan you participate in. For a different set of savers, for business owners, this will also only apply to your wages. So it might be beneficial for you to set up your compensation program in a way where you pay yourself market rates on your salary, basically the wages you earn, thereby keeping that salary probably lower than it otherwise could be. Then receive the rest of your compensation in the form of dividends. Under this format, you could theoretically earn $1 million and not be subject to this rule if you kept your wages lower than $145,000. So this is a big change, especially for high earners. With this coming in 2026, make sure you are maximizing the time you have left to contribute to pre-tax accounts with that catch-up. Come 2026, you will no longer have that option. So there you have it, 4 new rules for retirement accounts, and one that is an old rule, but I thought needed more attention. If you like this video, click on this video right here to learn about which of your retirement accounts is objectively your worst growing account and why. Click here to learn more, and always remember, you don't need more money, you need a better plan. Look forward to seeing you in the next video.